So as we get ready for the mortgages one, again, if you're in Slido, make sure you switch to the next topic. That's where you're going to want to put your questions in about mortgages. So just a quick thing about mortgages. One of the things when Zillow is our parent company at StreetEasy, and of course Zillow has a mortgages product. And their product is kind of like a kayak where you can go and sort of say, hey, I'm kind of looking for a mortgage and I'd like to see offers and rates that are live from real people that are out there and real banks and real loan officers. And so when we heard about that, we thought, okay, this is really interesting. Maybe it's something we should bring to StreetEasy and actually let our users be able to use this Zillow mortgage platform. And so a couple years ago, we brought that platform into StreetEasy and we put it on some of our pages. And we found something really interesting and really different, which was that as people used the interface inside of the StreetEasy product, 35 to 40% of the time, no mortgage lender nationally was able to respond or bid or offer any type of pricing. And it really opened our eyes that New York's mortgage market is very different. It's very localized. It's very specialized. And to have success here with a mortgage, you're not going to be able to call some national number. It's not Rocket Mortgage or anything like that. You're going to have to use a local specialist who knows about these buildings, who knows about co-ops. And a lot of that specialty is what we're going to hear about today from Tony Zhao.
My name is Tony Zhao. I am a residential mortgage loan officer with Investors Bank. We're a local bank, and we concentrate on condos and co-ops. And, mortgages in New York City, to say the least, is not the easiest thing to obtain. And one of the things I tell clients when you purchase a home in New York City is start the process anywhere from 90 to, I would say, 120 days. Because the pre-approval letter that you're going to obtain from a bank is probably the most single important piece of letter, so you know how much of a home you can purchase. As a matter of fact, a lot of the real estate agents in New York City, they're not going to work with you unless you have a pre-approval letter, because they want to know they're not wasting their time and that you're a serious and qualified buyer. So I want to say there's two components that, as a buyer, you should prepare things for. So the first part is if you're a wage earner, meaning that you get a W-2, you get regular pay stubs, have your two most recent pay stubs readily available, okay? The lender's going to want to look at everything on your pay stubs, including deductions, withdrawals, things of that nature. Have your two most recent years of W-2s. And some lenders will actually ask you for two most recent years of tax returns. Now, I've seen a client who was a W-2 wage earner, makes $100,000 a year, right? That's simple enough. But she deducted $20,000 a year in unreimbursed expenses. So that's why banks want to sometimes look at your tax returns, because they want to know what things that you write off on your tax returns. New York City is very complicated. You have a lot of buyers who work in finance or are commission-based. And if you're getting a bonus, banks can only use the bonus income if you can show 2 consecutive years of that bonus income. Otherwise, you cannot use that income. That goes the same with commission. You have to show 2 straight years of commission or bonus in order for them to qualify and use that income. If you're self-employed, that's fun. You'll need to show 2 years of tax returns for personal and business. And I don't know if anybody has or started something called a profit and loss statement. If you're buying a home right now and you're self-employed, the banks are going to want to see your profit and loss statement for the last year, because you haven't filed your returns, and there's a lot of companies or business owners that are not going to file their returns till the year end, sometime in October. So the banks want to know that you did just as well, or your income is in line within the last 2 years. So you have to have all those readily available for the loan officer of the bank that you choose to see before they issue a pre-approval. Talk about assets. In 2001, the US government passed a law called the Patriot Act. And the Patriot Act enacted banks to review everybody's bank statements when you're doing a transaction for real estate. So this is a very important thing for you to understand. When you buy a home, the bank will want to look at 60 days of bank statements prior to the date of the contract being signed. They're going to audit your bank statements. Any deposits that you have to be able to source, season, show where they came from. So if you have cash under the mattress, do not deposit it, okay? If you have family money, and when I say a gift from a family, because a lot of buyers in New York City will get a gift from a family member, they must be blood relatives. It can't be a close, distant godfather, okay? You cannot take that gift, and a bank can actually decline your loan if you get a gift from a non-blood relative. They're gonna find out, they're gonna want documentation. Now, after you provide all that information, eventually, the bank will wanna look at the co-op and condo that you're about to buy in. New York City has the highest amount of concentration of mortgages being declined because of the building you're about to buy in. Could you imagine that? You have great credit, you have great income, and you have a ton of money. But if the bank does not like the financials of that building, you're gonna get your loan declined. They will not lend to you. And I wanna say the statistics are 25 to 30% of buildings in New York City, most banks will not lend in. So if you look at StreetEasy, you'll see some listing agents and they'll say cash only. So those are some of the telltale signs. So obviously the lender's gonna check your credit, right? So you should know, and obviously this is a no-brainer, pay your bills on time, right? That's gonna be reflected on your credit report. Lenders, some lenders, they're gonna want a 12-month history of rent. What I mean by that, I don't know how, management company, post-dated checks or canceled rent checks, they wanna know that you're able to pay your mortgage or your rent on time. Because if you can't pay your rent, what's to say that you're gonna pay the mortgage on time, right? You're gonna obviously not keep that going. Keep working. You're going to need a job if you're gonna get a mortgage. I've had a client, a week prior to closing, she quit her job. She said, hey, you know what? I'm a doctor. I can get a job anywhere. I'm like, really? Well, until you get a new job and show us a pay stub, we can't close on your loan. Banks will do a verification of employment the week of your closing. Save your pay stubs, right? Especially if you're a bonus, if you're commission-based, we wanna know that how much your bonus is. And again, we can only use 2 years of bonus income. We can only use 2 years of commission income, and it will average to 2 years. You know, loan officers, I feel like in New York City, they have to work 7 days a week. My phone on Sundays does not stop ringing. They're calling me, they're checking in on the building. Hey, is 123 Madison Avenue approved? Because regardless of how well qualified you are, if they can't lend in that building, you can't get a mortgage. So ask as many questions as possible when you're working with a loan officer. Bother them all the time, does not matter. Text, email, calls, that's what a good loan officer should do. Okay, don'ts. You're closing on a home next week. You go to Siemens or IKEA and you apply for a $10,000 line of credit to buy furniture. Don't do that. Banks will do a soft check right before you close. They want to know that you didn't finance a Ferrari. They want to know you didn't open 5 credit cards. They want to know because it's going to affect your ability to carry the mortgage, to carry your credit cards. It's what we call a debt-to-income ratio. Moving money around. You know, there's a lot of, I guess, buyers who have money in the stock market. And if you're waiting for a board approval, you don't want to sell or liquidate your assets because you could have capital gains on it. So I think the key to something as far as moving money around is you have to be able to trace and track everything. If you have documentation, that is going to make the purchase process 100 times easier. You know, assets, wherever they go, make sure you can document it. Cash infusion. I think this is one of my nightmares when I see a bank statement and I see large cash infusions. First off, cash infusions, big no-no. Do not put cash into your account. Any cash you put into your account, that could cause the bank to actually decline your loan. Remember, any deposits, we're literally going to go through every single line of your bank statements, and we're going to point them out to you. We're going to say, where did this money come from? Show us proof. And that could cause you a lot of headache if you cannot. Closing costs. Ugh. You know, for a condo in New York City, just kind of put together in your head, right? If you're buying a condo in New York City, the average closing cost, and I'm not talking about bank closing costs, I'm talking about mortgage tax, transfer tax, title insurance, everything that's on that list. For a condo, it's somewhere between 2.5% to 3.5%. And if you're lucky enough to buy in a new development, I'm being sarcastic, you have to pay sometimes the seller's transfer tax, which is 1.8%, sometimes 1.9% of the sales price. Any property in New York City that you purchase over $1 million, there is something called a mansion tax, if you're lucky enough. So the mansion tax is applicable to every type of property there is. Condo, co-op, single family, does not matter. 1% of the sales price. And buying in New York City has its challenges. I think that checking the condo co-op, obviously you can't do that in the beginning of the process because you're doing a pre-approval, right? And once you find that specific property, that's when you hound your loan officer. Every bank for a co-op has an approved or declined list for a co-op. Now think about it. If you're going to buy into a corporation because you're going to become a shareholder of that corporation, you want to know that this co-op is financially stable. It's healthy. And I've seen this before. If you buy into a corporation or a co-op that is unhealthy, imagine 6 months or a year down the road, you get an assessment. Now, your affordability for a home is, let's say, $3,000 a month. And now all of a sudden, the management company says, hey, guess what? We need to do some repairs on the roof. We're going to raise your assessment. We're going to apply an assessment of $600 a month for 2 years. That's going to throw your budget off. And that could cause you, as a person who has a mortgage, to be late on the mortgage. Condos. Condos are tough sometimes to lend in because banks will not lend in a condo. They'll make exceptions if one entity owns more than 10% of it. So there's no master list for a condo in New York City, but they actually have a do not lend list. So I think one of the most important things, once you have that pre-approval and once you start looking at a property, is to check and I emphasize this so much because most of the denials that you get in New York City, it's not because of credit, it's not because of income, right? It's not because of your assets, it's because of the collateral, which is the building you're about to buy in. So doing your due diligence, getting your credit lined up anywhere from 90 to 120 days is key. You know, unfortunately, I usually get the call the month they're getting the month that they're about to buy. So some of this seems to be too late. You know, I have a client right now who has, 32 cash deposits in his checking account. And he's a self-employed borrower. And we just have no idea how to source it. You know, the underwriter said, hey, can you get me proof of where all this money comes from? And unfortunately, the loan will probably most likely be denied because banks, we all get our money from the same place, which is the Federal Reserve. So we all have to follow the same guidelines. So each bank, typically, they all have the same rules and regulation. So I cannot stress to you how important it is to speak to a mortgage loan officer or a banker at least 90 to 120 days. That way you can get all your ducks in a row and you know you're not going to have issues, and having this process go as smoothly as possible. Very important.
Awesome, thanks. We've got some questions here. I'll sit down here and go through some of them. So the number one question was, how far in advance do I get a pre-approval? And so 90 to 120 days.
I read your mind.
Got it. So are there ways to avoid paying mortgage insurance when putting less than 20% down?
No. Let me tell you, mortgage insurance is not something anybody wants to get, right? Because, mortgage insurance, technically, you're paying an insurance premium to protect the lender. I mean, you're not going to pay for your neighbor's life insurance policy, but in effect, that's exactly what it is. Because if you can't put down 20% and you go default, that insurance policy kicks in, and that's the only way that you're going to be able to get a loan. Now, in my opinion, there are banks that's becoming more aggressive in New York City, right? Because the buyers are very well qualified. So you may have some coming down the road 6 to 12 months where they will allow no mortgage insurance up to 85%. That's,
So maybe 15% in the future, but not now.
And the good thing about mortgage insurance is you can pay for an appraisal, let's say 6 months, a year down the road, and you can possibly have that removed if you pay for an appraisal. So it's not something that is definitely going to stay on the home for the rest or the maturity of the loan.
So I have a question from someone who is sort of a dual income situation where one of the incomes is a self-employed and has very kind of fluctuates wildly, it sounds like, and then a steady wage earner is the other partner. And so sort of wondering, how is a bank or a loan officer going to look at that and think about them as a candidate? Are they going to be penalized, or is it sort of an advantage? Or?
So I think banks can never penalize anybody for income. The only way you can get penalized is if you have terrible or lower credit score, because the money to the bank costs that much more because it's riskier. So banks will use the same, on an application, there's actually 2 sections. You have a buyer and a co-buyer. So for the buyer part, we'll put the regular W-2 or your pay stub earnings, and then for the self-employed part, we'll just average the 2 years. And it's actually relatively simple, unless you're a conglomerate and you own 50 corporations and we have to ask for 50 tax returns. That's when it becomes a little more complicated.
Got it. Someone has a good question. What about student loans, and how might that factor into this whole process?
Student loan is just like a credit card. Remember, banks, when they pull your credit, they're going to use the liability of what the monthly payment due is, right? So if you have a $50,000 Sallie Mae loan and the minimum payment on that is $100 a month, that's what we're going to factor in. So it's seen as sort of a credit card or a line of credit, and it should not affect the loan that much.
And so the next question is there a good publicly available source to get sort of general ideas of rates and be sort of quote online, that kind of stuff, for people in New York City specifically? I know, Zillow does have this, and it works, I guess, 65, 70% of the time. Certainly there's plenty of situations where we cannot give that type of information. Are there other sources specific for New York City, or it's really working with a broker?
I think walking into a local branch, most local branches will have a posting of what their 30-year fixed is, when you go online. But when you go online and you type in, fixed rate or interest rates, most banks will put what they call a teaser rate, right? A teaser rate is, hey, this is our best interest rate. They're going to put their best foot forward. And our teaser rate is 4%, 3.5%. And a lot of the times, that's not applicable to New York City because such a small concentration of a bank's portfolio is actually condos and co-ops. Remember, most of the United States are stick-built homes, single family, multifamily. So you're not going to have a lot of advertisers that's going to concentrate on a specific geographic area. And unless you work with a local lender, there's a lot of small local lenders in New York City that only will lend in New York City and the tri-state area. And those are the ones that know the market a lot better than your typical national lenders who doesn't understand New York City as much.
Next question is, how do I estimate the tax savings that I might get from a mortgage or mortgage deduction? Is there a good way or calculator to do that?
You know, I think that talking to your CPA is probably the best source because think about it, mortgage interest is a huge tax deduction for you, but it's also based on your tax bracket, right? Somebody who makes $80,000 a year may have a different mortgage write-off interest versus somebody who's making $300,000 a year. So there's no exact science, plus how much you deduct, what kind of line of work you're in. So I think a CPA, somebody who knows your tax filing, your tax breaks will probably be best to guide you. And my advice is the first year, and a lot of people use these softwares to file their tax returns. But for the first year after you, or when you buy your home, I think it's crucial to work with an accountant or CPA because there's so many tax deductions, including closing costs when you purchase a home that you can take advantage of. And sometimes when you plug in those numbers on TurboTax, you're not going to be able to get the larger tax breaks as opposed to going to a CPA or somebody who is a professional at tax filing.
So the next question is, someone says, I hope to be able to make faster payments on my loan, right? So I hope that's always a very good thing to be able to do if you can do it. Would it be better if I think I'm going to be able to make these extra payments? Should I have a fixed rate mortgage over a 15 or 30 year, or should the adjustable rate mortgage maybe is better for me if I'm going to be more aggressive about paying down my loan?
I think the type of mortgage that you choose should not be the reason why you pay off the loan faster. Because unless you're a millionaire, you're not going to be able to pay off your mortgage after a year or two. And I would say, an adjustable rate mortgage. An adjustable rate mortgage is a mortgage that is fixed for only a certain amount of time. And at the end of that term, the rate's going to adjust. So I think Grant mentioned that your average homeowner in New York City lives in their apartment for 5.8 years. So if you live in a property, and the difference between a 30-year fixed rate and a 7-1 ARM, the interest rates may be half a point, sometimes 3/4 of a point difference on the lower end. So the reason to choose an adjustable rate mortgage is for that fact. You're not going to stay in that home for more than 30 years. You want to get out of that home. You need the down payment to buy a house in the suburbs when you're going to have your family. So that's the reason why you choose a 30-year fix, a 20-year fix, or an adjustable rate mortgage. Now, coming back to that, so banks, they want you to prepay sometimes. They want you to prepay the mortgage. But I think one of my accountants has said to me, Tony, if you have a 4% mortgage and you have a tax deduction after your mortgage interest, what is your realized rate? Is it 2%, 2.5%? So imagine getting money at 2 to 2.5%, right? Do you really want to put your liquid assets into something, a vehicle, that's 2.5%? Wouldn't it be better off in the stock market where it's collecting 5, 6, depending on what time it is or what era we're in? So I think that paying off the mortgage earlier, it depends on the individual. But if you're getting money this cheap, why throw it towards the mortgage if you can use the tax deduction on it?
Yep. So interesting, a qualifying question on our most popular question. The 90 to 120 days that you advised, is that before submitting an offer or before the expectation of closing, right? So we heard today that sometimes it's, if you're buying a co-op, it could be, 3 months basically. So should they, is it too far in advance, right? If they talk to you the 90 to 120 days before they put an offer on a co-op and the co-op doesn't close for another 3 months, is it too far? Should they have talked to you, kind of later in the process, or what's your thought?
I think if you're financially savvy, right? You have Credit Karma, you know your credit scores, you know that your assets are in place. I think 60 days prior to you looking for an apartment is key. But not everybody knows mortgages, not everybody is in finance, right? So if you're not financially savvy about these type of situations, buying a home, stock market, your assets, I think 90 to 120 days for the average folk is plenty of time before you look for the property. Because I'm talking about the 5 or 10% of the individuals out there that really need some guidance into getting a pre-approval. So 90, 120 days, if you're not financially savvy, if you know your credit score, if you know where your money's coming from, it's very plain and vanilla. I think, 60 days is key.
Okay. There's a question about some co-ops that are HFDC with income restrictions and but still require 20% down. Are those buildings potentially on the red, the not available list? Would banks sort of shy away from those types of buildings and offering loans, or?
Sometimes. So HDFC buildings is income restrictive, meaning that you can only make under a certain amount for you to get into this building. And there's a lot of them in the upper west side. There's one that just opened up downtown, right by Wall Street. So banks have a list for HDFC buildings. Now, every time you do a mortgage, you have to think why mortgages are so tough to get. They always think the worst case scenario, which is foreclosure. So if a bank has to take that property away from you, they just can't sell it to anybody. They have to sell it to a very specific person that fits the profile of that HDFC. They have to make a certain amount of money. They have to pass the board. So do banks love HDFC? No, but they will lend in it. They look at HDFC buildings as if it was a regular co-op. The issue you have is that HDFCs, they have a flip tax. Sometimes the flip tax is 10, 20%. So banks, their law or their rule across the board is flip tax cannot exceed 5% of the sales price. So if you have a lot of HDFC buildings, that's 20%. Imagine you sell an apartment, you have to pay 20% of what it's sold for at closing. Lenders are not going to want to lend in that. So unless the HDFC co-op changes those rules, and some actually do for the sake of getting a mortgage, banks typically will not lend in an HDFC building. But if they have a 5% flip tax or under, they absolutely will.
And so there's a question about the fixed rate or adjusted. Is that something that the bank or the mortgage officers is really going to walk you through all those scenarios and kind of help you understand what is personally best for you, or is that something that people will have to research on their own?
I think for me, I can speak for myself. When I talk to a new buyer, and if, most buyers will say, hey, I'm looking for a 30-year fixed. All right, done. Here's our rate. Let's get going. But if they have these questions, I usually want to talk to them and kind of feel them out and walk them through the process and tell them, why would you do a 7-1 ARM? Rates are historically low, and in 7 years from now, most likely interest rates will be a lot higher. 7, 8 years ago, I was, I guess giving rates at 6.5% and 7%. And when somebody had a 6.5%, 7%, they were jumping for joy because that was a great interest rate at the time. So it does vary, and I think it's very important for you to figure out how long you want to stay in the apartment. And at the end of the term, are you going to sell it, or is this going to become an investment vehicle for you? Because if it is, then a 30-year fix is probably best. In condos and co-ops, there's no investment property loans for co-ops. Just let everybody know. Banks cannot lend in investment properties for co-ops, but they will do for a condo. So think about this. I mentioned that condos and co-ops are hard to lend in because banks typically will not like the financials and they decline it. So you do a mortgage today in a condo and it's approved, but 7 years down the road, 10 years down the road, what if something happened to this condo financially and you can't do a refinance? What do you do then? Imagine rates going from 4% when you locked it, or 3.25%, and all of a sudden it's at 7, 8%. Your mortgage payment is essentially doubled. So it's very, very important for you to know that if you're going into a non-fixed rate, you're going to be out of this loan within that time frame.
So the last question, and this may actually be something we have to ask our agent panel as well, is when you get pre-approved, let's say you got pre-approved for a $600,000 loan, but you want to make a bid on a property only at $500,000 or $550,000, you don't want them to know that you can spend up to $600,000. So how do you sort of navigate that? Hey, I'm pre-approved, I can spend everything that I'm offering here, but I don't want you to know that I'm being pre-approved for more.
I get that all the time.
Okay.
And I think that, so once a bank issues one pre-approval, they don't have to keep pulling your credit. They don't have to keep on rerunning your profile. If the loan officer knows your max is $1 million and this property you're looking at is $799, we'll start with a $799 pre-approval. And if you want to go higher, all you have to do is just call the loan officer, and they can print out an easy PDF version of the pre-approval, and they can work with you throughout the process based on the loan amount or the sales price that you're looking for. But they do not repull your credit. Credits are usually good for up to 90 to 120 days, so that's not going to affect your credit at all.
Great. Awesome. Thanks, Tony. It was really great.
Thank you very much. Thank you.